attending this particular webinar. We have a wonderful guest, Marnette Myers. And before we actually introduce her, we're going to go ahead and go through some disclosures. She is a partner at Pragus Metas, and they are also an international group. Marnette is a certified public accountant and a licensed attorney practicing in the Commonwealth of Virginia. She has been practicing for over 20 years and is with expertise in overseeing supervising corporations, nonprofits, corporate partnerships, fiduciary, and individual taxes. Marnette works with closely held businesses to develop strategies and to reduce their taxes. She also gives regular presentations to local groups and organizations regarding tax planning, changes in tax laws, as well as regulations. Marnette has been recognized by the Northern Virginia Magazine and Washington County Magazine as a tax advisor in the Metropolitan DC area for several years now. I've worked with her for several years myself, and it's always a pleasure to hear her speak. Marnette, with that, I'm going to go ahead and have you begin the presentation.
Okay, hello everyone. I know I think everybody was having a little bit of a hard time hearing Carmen. So I hope you can hear me and everything is going well on that end. If you can't or having any trouble hearing, please put a little note in the chat and we will make sure we can fix that for everyone. And just to reiterate, if you have any questions, please put your question in the Q&A area. We will do our best to answer them as we go. I'm perfectly happy and willing to answer any questions along the way. If you have them at the end of a slide, that's a great time to ask a question before we move on to the next topic. But in the meantime, let's get started, everyone. And we're going to talk about tax considerations as you look towards retirement. And so this is just the general, I guess, listing of what we're going to cover today. So we're going to go over Social Security just generally. And then we're going to talk about retirement distributions, Roth IRAs, whether or not you want to pay off your mortgage. Now that you're heading into retirement, whether you can possibly get a medical expense deduction this year on your taxes. And then the ever happy topic that everyone likes to talk about, quarterly estimated tax payments. And if you just finished your tax return in the last couple of weeks, this is probably something you have looked at and been talking to your tax preparer on just recently. So we can now, let's talk about Social Security. And this is just going to be a really brief overview on Social Security. I'm sure your investment advisors at EBW go over this with you in depth, and we'll do a great analysis of whether you want to take early, which is a rare situation, wait till full retirement, or maximum. So I don't want to get into any of the super details there, just kind of a quick overview to remind you that the earliest you can get Social Security is at 62 years. Full retirement age is between 66 and 67 based on your date of birth, and the maximum is at 70 years. So by no means should you be waiting until 71 or 72 for Social Security, because you're not gaining anything. In fact, you're just leaving money on the table. So if you certainly want to make sure you apply by year 70. For most of you, your Social Security income is going to be taxable on the federal side. And if you see the amounts there, it's once your income's over 44,000 for a married couple filing jointly, 85% of your Social Security income is taxable. So for most everyone, that is going to be the case. If you live in Virginia, for example, Virginia does not tax Social Security income. So it wouldn't be taxable on the state side. Each state is different. Some have different rules. Every state has different rules, but I assume a lot of you are local here in Virginia, and therefore you don't have to worry about that. And then the last point is just to make sure you don't forget to file for Medicare at age 65, even if you're not going to take advantage of Medicare at that point. Just apply. If you apply after age 65, there are penalties for later applications. So just at least make sure you get your application in there, even if you don't plan to take advantage of Medicare insurance at this time. So we can move on to the next slide now. And here's where we really get into the heart of what we're going to start talking about. And this is your retirement plans. As many of you probably know, if you have money in an IRA or 401k or 403b or so many different other kinds of plans, at a certain point in time, you do have to take a required minimum distribution, an RMD. Sometimes I see this abbreviated MRD. I tend to use the RMD vernacular, so just stick with me on that one. Currently, the rules are you have to start taking a required minimum distribution when you reach age 72. Now, not too long ago, that was 70 and a half, but with the Secure Act that passed, I believe in late 2019, that changed the age to 72 moving forward. So that is something to keep in mind. In the year you turn 72, you do have the ability to wait until April 1st of the next year to take your first required minimum distribution. But if you do that, you're going to have to take a distribution for your age 72 and that current year. So you kind of double up on the RMD at that point, and usually not an ideal way to go with it. But it does work in some cases, and your investment advisors at EBW will certainly work with you on that as well to see if that makes sense in your situation. Like I said, as my favorite response is when somebody asks me a question about taxes, the first answer is always, well, it depends. There is no one size fits all. So everybody has a different scenario. Everybody has different things they're looking to do or, goals to achieve. So first answer is always, it depends. There is no one size fits all for investment advice, and there's certainly no one size fits all for tax advice. So, generally, as I say, probably don't want to double up on a year for required minimum distribution. However, it might be the case that that works in your favor. Now, there is one exception to taking a required minimum distribution in a year, and that is if you have a 401k or some other type of retirement plan at a company where you are still working. If you're still working there, you may be able to delay your required minimum distributions until you retire. So let's say you are working and you want to continue working until age 75, for example. You can delay that until you actually retire from the company. Now, one big issue that changes the rules in this case is if you are an owner of the company or you're related to the owner of a company, of that company where the retirement plan is, then you are not able to delay your RMD. So if you're just an employee with no ownership stake, you are able to delay the RMD if you continue working. But if the company is your own or spouse or any other rule for attribution for related parties, unfortunately, you cannot do that. So just keep that in mind. It's a little quirk that sometimes allows you to delay taking an RMD, but it's a very limited exclusion there. Now, one thing, I don't know if you've kind of been listening to the news and all this fun stuff, but there is a new Secure Act that is making its way through Congress that may change some of these RMD rules. Right now, I believe it's the end of March, the House went ahead and passed, I believe they're calling it Secure Act 2.0. It's a very, they're very, very innovative with these names. And under Secure Act 2.0, this may delay required minimum distributions up until age 75. And that would 75 would be if you are born, if you attain age 75 in 2032 or later, then you can delay the RMD until 75. There's basically a phase in. If you're 73 in 2022, you get to delay it to age 73. If you're 74, starting in 2029, you get to delay it a little bit as well until age 74. So that is just making its way through Congress. As I said, it's passed the House. The Senate has not taken up the vote yet on their own version of Secure Act 2.0. So it's hard to say what the ultimate end result will be, but this is something that could be changing just this year. And we will, certainly try to keep you abreast of these changes as they come down the pike. But we'll have to see. Like I said, the Senate, as of yet, has not taken up a vote. I think the last I saw, they're thinking maybe May or June, probably before the recess for the summer. So we'll see what happens there. Now, when you do take money out of a retirement plan, an IRA, a 401k, the distributions are generally taxable unless you have basis. Now, how you get basis in a retirement plan is kind of threefold. The first is if you have an IRA that you've made non-deductible contributions to on your tax return. If you've been doing this, you've been tracking this in a form 8606, and it's been tracking your basis over time. Now, as you take money out of your IRA account, what they do is they look at the value of your IRA account, the amount of basis you've put in, and there's a pro rata calculation to determine how much of the distribution is actually taxable. So if you put in 10,000, because I'm going to use numbers I can maybe do in my head, and your IRA is worth 20,000 this year, and you take out, let's say 5,000, basically half of that distribution is going to be taxable. So you would pay tax on 2,500. That's something you do need to track. Your basis, make sure you're keeping track of that on your tax return every year, and you're reporting any non-deductible contributions you make. The second way you can have basis in a retirement account is if you made after-tax contributions to a 401k at your job. This is somewhat unusual. We don't see this too much anymore, but it is possible to have that. If your money is still within the 401k, the plan itself should be tracking what you have put in that's taxable and what is non-taxable. So that should be taken care of at that point. When you roll over a 401k into, let's say, an IRA, and you had some of these after-tax contributions, just make sure that that information is being tracked and relayed to your new IRA holder. So, if you transfer 401ks, for instance, to EBW, make sure they have information on how much of that distribution came from after-tax contributions. And the third, and we're going to talk about Roth IRAs a little bit later, but the third is a Roth IRA. The rules are completely different from Roth IRAs, and we're going to get to that in, I believe, the very next slide. So we'll get to that shortly. And I know someone had a question about Roth IRAs, so we'll get to that in just the next slide. It's like you're reading ahead, but we're going to go back for just 1 minute to talk about one other thing there. If we can go back to just retirement plans. One of the big changes that came from the Secure Act of a couple of years ago is that you can contribute to an IRA after age 72 going forward. It used to be once you hit 70 and a half and you had to take a required minimum distributions, you couldn't contribute to an IRA anymore, even if you had earned income. Secure Act got rid of that rationale. So as long as you have earned income, you are able to continue contributing to IRAs after age 72. But like the big, hurdle is you have to have earned income. So that's, income from a job or from consulting. It doesn't count any dividends or interest or even, required minimum distributions you've taken from an IRA. So none of that counts towards earned income. But this is something I've, definitely seen some people taking advantage of going forward, still being able to continue to contribute to an IRA after the required minimum distribution age. And the last thing I want to talk about just general retirement plans are qualified charitable distributions. And I have seen a huge uptick in people taking advantage of qualified charitable distributions. And what this is when you take money out of your IRA for your required minimum distribution, try not to use too many abbreviations here because there's a lot of them floating around. You can, instead of taking the money directly to yourself, you can say, IRA holder, I want you to contribute $10,000 of my distribution directly to my charity of choice, be it your church, cancer society, any qualified 501c3, you can have that money go directly to the charity, doesn't come to you. Now, when this happens, that part of the distribution is not taxed to you. So the way when I see this so much now is a lot of times after retirement, let's say you pay off your mortgage. As we all know, state and local taxes, you can't deduct more than $10,000 anymore. So a lot of you aren't to the point where you're taking itemized deductions. So by using a qualified charitable distribution, you essentially get the benefit of making a charitable contribution without having to itemize. So it's a great way to, get a charitable deduction, the benefit of it without having to itemize. So I'm seeing this a lot with my clients. It's a, great way to, use up some of your RMD by giving money to charity and still getting a tax benefit from it. The only thing you want to watch out for is when you get that 1099-R reporting your RMD for the year. So let's say you have $100,000 RMD, your 1099-R is going to show $100,000, even if you gave $10,000 through a qualified charitable distribution. So you need to keep track of that contribution. You need to make sure your tax preparer knows about it because it's not going to show up directly on the 1099-R. And when you do a qualified charitable distribution, you will need to get a contemporaneous written acknowledgement, as they like to call it in IRS terms, from the charity that you gave a contribution. So you should still get the same type of letter like you would even if you wrote them a check out of your own bank account that says, you gave $10,000 to the Marnette Myers Foundation, for example, which is not a charity in case anybody's wondering. So you would still get an acknowledgement letter, and you need to have that if the IRS were to ever ask about your charitable contributions. So this is a great way, especially recently with IRA values just going higher and higher, which is great. So a lot of people, the RMDs have been getting higher and higher, and this is a way to, satisfy your RMD and do a donation to charity at the same time. So we can now move on to Roth IRAs, unless there are any questions on this. I don't think so. I think we're good. So let's go on to the Roth IRA slide. So, and I think the very first question we had was, is there an RMD from a Roth IRA? And the answer we have right here is no required minimum distributions from Roth IRAs. So this is one of the benefits of a Roth IRA. You don't have to take a required minimum distribution. When the money comes out, generally not taxable. And I say generally because you'll hear me say that a lot. A Roth IRA is not taxable if the account's been open for at least 5 years, which is the biggest hurdle there. And it's not an early distribution. So, 95% of the time when I see something come out of a Roth IRA, it's not a taxable distribution. And that may even be a low estimation. It's probably closer to 99, but there's always that 1% that happens. So, you don't have to take an RMD. The best time, and what I'm guessing a lot of you are coming up with, is either you're newly into retirement or just getting ready to kind of plan for retirement, is the ability to convert an IRA to a Roth IRA. Now, anyone can make contributions to a Roth IRA if your income is low enough. The income is not, threshold is pretty low. So it's kind of hard for people to make a direct contribution. So what I see a lot of people do is convert an existing IRA to a Roth IRA. Now, when you do this, 2 things happen. One, generally this is a taxable event. So you've got to be, prepared to pay the tax on it. 2, sometimes you can do a portion of it in a non-taxable event. If, as we talked about in the IRA slide, you have basis in an IRA. So there's a whole rationale and theory for doing an annual contribution to a Roth, and that's not something I really want to get into in this presentation, but it is out there, and it works in limited areas to do it annually and be able to avoid some tax on it. But what we're going to focus on is converting a larger number. So for instance, if you have $100,000 in a traditional IRA and you would like to convert that to a Roth, and we're going to assume no basis, that $100,000 conversion is taxable to you in the year you do the conversion. So the reason we like to target this time frame to do it is because you've retired, you are probably not taking Social Security yet, and if you're below age 72, you're not required to take a required minimum distribution. So this is probably the lowest tax earnings year for you that you're going to have, in your lifetime, in that small window from the time you retire until the time you take Social Security and you have to take RMD. So it's a limited window, which is why it's a great time to look at this, because like I said, you're probably at your lowest tax bracket that you've probably been in years, maybe 20 and 30 years. So we have a nice little, valley here to kind of jump on this opportunity. So that's a great way to do it. You're in a lower tax bracket, so it's a great time to do it. I generally like to say, to focus on, if you're going to be in the 25% tax bracket or lower with the conversion, that's a great time to do the conversion. Kind of when you get over 25%, a lot of times, it takes a bit more, I guess, thought and planning to see if that makes sense in your case. But it can. I had a client who converted $2 million from an IRA to a Roth several years ago. And clearly at $2 million, that's not going to be in the 25% tax bracket, and turned out to be a great move in his case. Now, most people might not be the best move, but it turned out well for him. So, like I say, when I generally say 25% is, what we focus on, that's great, but it can work in other cases too. Now, when we do this conversion, and why a lot of people do it, is because they're moving money out of a traditional IRA, so it's going to reduce a future RMD. Also, you don't have to take RMDs for Roth IRAs. So what a lot of people were doing is they're using Roth IRAs for almost for inheritance, so that way when it passes down to ultimate beneficiaries, it's not taxable to them at that point in time. So that's kind of why we're focused on this. And again, because you're going to be in a great lower tax brackets, this is a perfect time to do it. Some things to just kind of keep in mind that, right now that there are some potential tax law changes coming up with Roth IRAs. So if you have a large Roth IRA balance, they're coming after those and making you take money out if it's more than 10 million. And if your income is a certain amount, they're even potentially talking about not letting you do Roth conversions. So, this is an ever evolving area that we, want to keep on top of. Another way that you want to look at Roth IRAs, and a great time to do it, is, at a point in time, if the market does dip down, so the value of your IRA is lower when you do the conversion. That's something to think about as well. So you kind of get more bang for your buck. You're converting at a lower value, not having to pay tax on it, and then letting it ride back up again with the market as it increases in the future. So we watch out for things like that. So let's talk about, I see there was a question about, are Medicare premiums impacted by Roth conversion? And they are. So if your Roth conversion is taxable, then it will go into your overall income threshold, which determines the IRMA adjustment for Medicare premiums. So if you do a large Roth conversion, it could kick up your Medicare premiums for 1 year. As I assume most of you know, that is Medicare premiums are adjusted year to year. So if you just have a 1 year spike, that will increase your Medicare premiums for 1 year, but then it will drop back down as your income drops in the next year. And the Medicare premiums are basically 2 years behind when you do a conversion. So if you do a conversion in 2022, it's generally going to impact your 2024 Medicare premiums. So I think that's all we have on the Roth IRAs. So I think we can move forward, and let's talk about paying off your mortgage? And this is a huge question that I get from not just people looking into retirement, but almost any age. And there's two different philosophies on this. And one is, making a tax decision versus making a life decision. And while I like to think, since I'm a tax professional and I do taxes every day, that taxes should rule the world, and every decision you make, they don't. So taxes are just one part of any decision you're looking at in financially. What might make sense from a tax perspective may not make sense for your investment advisor, because they have a different theory for you, or may not make sense for you for how you want to, live your financial life and what you want to do. So, just keep in mind, and, like I said, taxes are just one part of your decision-making process. So from a tax perspective, generally I say, don't pay off your mortgage. You're getting a deduction for the mortgage interest you're paying. It's allowing you to itemize your deductions. And so from a tax perspective, usually a mortgage is a good thing. Now, it's going to depend on how high is your mortgage. If you have a new mortgage, say you've purchased a home since 2018, if you have a mortgage debt of more than $750,000, you can't take a full deduction for that interest. Your mortgage debt is capped at $750,000. If the home was purchased prior to 2018, then it's $1 million of mortgage debt. So, maybe it does make sense to pay off some of it if, you're not getting a full deduction. But the biggest thing to look at is, what is your interest rate? Interest rates are so low these days, and I know they're going up a little bit. But, if you're looking at, a mortgage interest rate of say 3.5%, and, you're got your money in the stock market, lately we've clearly all been making more than 3.5% in the stock market. So, you're making good use of your money. You're taking that money, earning more than 3.5% on it, paying a mortgage interest, of the 3.5%, and getting a deduction. So really your effective mortgage interest rate is probably something closer to, 3.25 or 3%. So in the grand scheme of things, you're making money on this deal. So that's one way to look at it. Now, another thing that we look at in retirement, if you're not going to have the same kind of income you had coming in regularly, maybe you don't want to make your own, make a mortgage payment every month, or have to deal with that when you don't have the same kind of income coming in. For example, my own parents, despite me saying from a tax perspective, you should keep these mortgages, paid off their mortgages. Didn't listen to me, because to them, it was more important not to have to make that payment every month. They didn't want to have that hanging over their head. They didn't want to worry about it. So, like I said, they made a life decision over, a tax decision, and didn't listen to their very own daughter. But I'm over that. It's only been, 15 or 20 years, but I'm over it. Okay, maybe not, but that's okay. For them, it made sense. And that's what matters. What makes sense, to you. If you do pay off your mortgage, just remember that money's got to come from somewhere. So you might have to take it out of the market, which means you're not going to have any benefit of earning money in the stock market. You may have to pay capital gains when you pull that money out of the market. So, paying off your mortgage can have some impact on your taxes over and above that. And of course, if you do pay off your mortgage, you're most likely not going to itemize your taxes anymore, or you're not going to itemize your deductions for tax purposes. You're going to move to the standard deduction. Right now, the standard deduction is like $24,000 for a married couple. And of course, you can only do $10,000 in state and local taxes. So unless you have $14,000 of charitable contributions and or deductible medical expenses, you're taking the standard deduction. So, that's why we want to start looking at like the QCD that we talked about earlier as an option to, kind of take, more benefit from your taxes in this way. So just keep that all in mind. It's a decision for most people. This is a life decision versus a tax decision. So just make sure you're keeping track of, what is this going to do to you? And, how are you going to get the money out, and what tax implication is that going to be if you do pay this off. So I think we can move on, and we're going to talk about medical expense deductions. Now, this is something that most people normally don't get a deduction for. And, that's a good thing, because as I tell everyone, if you're taking the medical expense deduction, that means you've had a horrible year medically and or a horrible year from an income perspective. So it's not something we aspire to do. But once you get to retirement age, we see this more and more. And we see this deduction more and more because your health insurance premiums aren't coming out pre-tax like they were before. As an employee, whatever health insurance premiums you pay or your employer pays for you comes out of your wages before taxes. So you don't get to include your health insurance premiums as a medical expense for tax purposes. Once you retire, many times health insurance premiums are paid after tax. If it's Medicare, premiums are after tax. Your Medigap and supplemental insurance premiums are all after tax. So these now become deductible medical expenses for you. And that's not, a small number. If you're maxed out on the Medicare IRMA adjustment, I think you're, talking at $5,500 or so for the year per person. For, married couple, we're already up to $11,000 in just Medicare premiums. So, your medical expenses start to add up. To be deductible, your medical expenses have to exceed 7.5% of your AGI. So if we're at $100,000 of AGI, you can't deduct medical expenses until they're more than $7,500. So in, my example, if you had 5,000 of Medicare premiums and Medigap and other things like that, if we're at 10,000 of medical expenses, that means you get to deduct 2,500 of those against your itemized deductions. What a lot of my clients do is when they, send me their tax information, they say, should I track my medical expenses? Should I gather that information for you? Because it's a lot, to get your prescription, your copays, and all that good stuff. So what I normally do with them is I say, let me calculate your AGI for the year, and we'll go from there. And, I say, hey, your AGI is 100,000. Did you have medical expenses of more than 7.5%? They say, pretty sure I did. Then I say, go ahead and, start gathering all that information. But, that way they don't waste their time, going through everything. And I say, thanks for giving me all this information. You still don't qualify. So, we kind of say, keep track of it, but maybe don't stay, too far on top of it until I know what threshold we're talking about to see if it makes sense. So things to keep track of, like I said, health insurance premiums. Your Medicare premiums are going to be on your 1099 SSA from Social Security. So we're going to have that. That's easy, nothing to track there. Long-term care insurance is something that a lot of people kind of forget about. It is includable as a medical expense deduction. There is a cap on how much is deductible based on your age. So if your long-term care insurance premium is $20,000, we look at your age and say, oh, you can only deduct $4,700 of it. So there is a limit there. But something that is a nice little quirk in Virginia, at least, is that if you don't take medical expenses on your return as an itemized deduction, for instance, let's say you take the standard deduction, your long-term care insurance premium is a deduction on your Virginia return. So even if you're taking the standard deduction, make sure you give your tax preparer your long-term care insurance, especially if you're in Virginia, because you do get a deduction on the state return. Now, it's not a huge deduction, but it's something to certainly keep track of. Other things that you see on medical expenses, mileage to the doctor, parking at the doctor, the hospital. If you had to pay transportation costs for a medical appointment, keep track of that. And one of the bigger things we see now is just long-term care expenses. So in a year that, for instance, you buy into, one of the local assisted living facilities, a portion of that buy-in and a portion of your fee every month are medical expenses. You will get a letter from the facility, usually in January, where they tell you that, based on some, I don't want to call it voodoo number thing, but on some actuarial computation that some type of CPA firm does, X% of your monthly fee is for medical expenses. So make sure you keep track of that. How much have you paid during the year, and give that letter to your tax preparers. They can see, if that then bumps you up over the AGI limitation. Another thing is, if you are to the point where you're in a long-term care facility and you need, constant supervision, and I believe is if you are unable to perform 3 of daily living tasks, then 100% of your fees to these long-term care facilities are considered medical expenses. So, if, heaven forbid you're in, diagnosed with Alzheimer's and you're in a memory care unit, 100% of that fee is deductible as a medical expense. If you have long-term care insurance and you get reimbursement for some of those expenses, then that amount is not deductible. So if you paid in $100,000 and you had long-term care policy that gave you $75,000 reimbursement, which would be great because, like I said, these things are very expensive. Only $25,000 then of whatever's left, whatever's unreimbursed, is deductible as a medical expense. So, just watch out for that. Like I said, the year you buy in, a lot of these facilities have like a large buy-in in year 1. In addition to the monthly premium and monthly fees that they charge, a good portion of that monthly, that initial buy-in can be considered a medical expense and deductible. So keep track of that. If you are looking into long-term care facilities or assisted living, make sure you get all that documentation. You ask how much of this is considered medical expense, because that matters and can certainly be deductible when we're talking about dollar figures at this amount. Now, depending on the facility and what type of care and level of care and all that good stuff, it all depends. Some of the buy-ins are refundable, therefore it's not medical. So just make sure that's at least one part of what you're taking, keeping track of when you're considering this kind of move. And, just make sure that's part of your decision-making process while you're doing that. And then I think that's pretty much everything on medical. And now let's talk about quarterly estimated payments. And everybody just loves this topic. So when you get to retirement, there's certainly some reasons why you're going to start making quarterly estimated payments, as opposed to, when you haven't been taking this before. So one of the main reasons is a lot of retirement plan distributions may not have tax withholding. So if you're taking money out of an IRA or 401k, they may not withhold. They may withhold at 10%. And I don't know who there are very few people who are in the 10% tax bracket. So that withholding is going to be really low. Social Security does not have any taxes withheld. And as we mentioned just a few slides ago, for most of you, 85% of your Social Security income is taxable on the federal side. So that's more income without withholdings. Investment income, your dividends, your capital gains, all of that, just as it has been, previously, there's no withholding on that. So, you have a lot of income now that may not have withholdings. Before, when you had a job, you got a W-2, there was always withholding. So a lot of you didn't have to make quarterly estimated payments. But in retirement, your income, a type of income, your income stream is completely different, and your withholdings are completely different. So we need to reevaluate everybody's withholdings and estimated payments at that time. Now, there's a couple of ways to do this. I mentioned Social Security doesn't have withholding. You can voluntarily ask Social Security to withhold from your monthly distribution. I believe the maximum withholding they will do is 22%. So there is a cap on how much they will withhold. So, you can't say, please withhold everything and make it taxes. They won't do that. There's a limit. A lot of retirement plans will not do state withholdings. So you need to watch out for that. So, in the year you're coming up on retirement, you definitely want to work with your investment advisor, you work with your tax preparer to say, hey, what do we need to do? Now, there are two different ways to deal with estimated payments. And so somebody just asked, are you required to do estimated payments? And so the technical answer is no, you're not required, but if you don't meet the IRS rules, they will charge you interest. So, they're happy to charge you interest if you pay no estimated taxes. And I have clients who refuse to pay it because they would rather just pay the penalty. And, fine, life decision, not a tax decision, as I would say. So the first way to kind of avoid any penalty on your tax payments is paying in 110% through estimated taxes and or withholdings of your prior year tax. So if your prior year tax was $10,000, because again, I'm going to use dollars math I can do in my head, was $10,000 was your total tax liability for the year in 2021, for example. In 2022, you're going to want to pay in $11,000 of taxes through your withholdings or through estimated payments. Now, the other option is to pay in 90% of your current year tax. So for example, 90% of your 2022 taxes. Now, who knows what that's going to be, because, we're not going to know what that dollar figure is until the, next year. So why we normally try to use 110% of the prior year tax. We call the safe harbor. It's a known amount. We can come up with it and we can, say, hey, this is a known figure. We can go with that. Doesn't always work because, for example, let's say you made $100 million this past year. So your taxes were really high. Now, if you don't expect to earn $100 million in 2022, we certainly don't want to safe harbor you at 110% of your current, of the tax from 2021, because that's going to be exorbitant. So then we're going to say, let's focus on what we think 2022 might be for you. And we kind of have to, do a little calculations and projections to see what's going to happen. So that's, two ways there. Now, I said you can do this through withholdings. Partially, you can do it through estimated payments. The IRS does want you to pay your estimated payments evenly throughout the year, because they assume that you earn your income evenly throughout the year. Now, that is a false assumption because hardly anyone earns their income evenly throughout the year, but that's our baseline, is to assume evenly. If you have an unusual situation where you earn, let's say, again, $100 million, but you earn that in December of 2022, the IRS will look and say, oh, well, we assume you made that even throughout the year. Your tax preparer can say, hold up, that assumption is false in this case. We need to look at it and say that wasn't earned until December, and they'll, recalculate if there's any penalty due based on that amount of income not coming till the very end of the year. So there are ways around, not the estimated payments, but the penalty that might come into play depending on how and when you earn your income. That can always be reduced if it's fine. But, the easiest way, like I said, if your income is fairly standard from year to year, is to go the safe harbor route. It's going to save you on interest. Now, interest right now with the IRS is at 4%. That's the amount through the end of June. They changed their interest quarterly, and it's all based, connected to prime and whatever the rate is there. So right now we're at 4%. For a while it's been 3%, but it just went up on April 1st. So we're not talking huge dollar amounts, and the penalty is only on the underpayment. So in my earlier example, when I said you had $10,000 of tax in 2021, your safe harbor figure is $11,000. Let's say you only made payments of $9,000 through withholdings and estimated payments in 2022. So you didn't meet that 110% $11,000 figure. The penalty is only calculated on that $2,000 shortfall. You paid in 9, you were supposed to pay 11, so it's interest on the 2,000. So it's not, there's many times where it's not a huge penalty. So that's also something, again, tax versus life decision, that, whether it makes sense. Some of my clients will say, I don't have $45,000, let's say, for their final quarterly estimated payment, and they say, what would my penalty be? And I say, oh, I did the math, maybe it's gonna be $150. So like, that's fine. I'm going to wait till April to pay it. So, just keep that in mind. There is a penalty if you don't. So, we watch out for that. But, for most of you, because you're not going to have regular withholdings, it's going to be to the point where you're going to do quarterly estimated payments. And, the IRA, you can do, depending when you take out your, required minimum distributions, you can do it all in one fell swoop. I have some clients who say, I'm just, my last RMD for my IRA I always take in December. And, it's usually a $15,000 distribution. They just do that all the taxes. And they say, put, 12,000 to the federal and 3,000 to Virginia. And I'm not going to take any actual cash out of that distribution. And if, the holder of your IRA is willing to do that, that's great. And if you're working with an investment advisor like EBW, they can certainly work with you on things like that to kind of help, plan that out throughout the year and see what makes the most sense. Now, I will say, one more thing on here. We talked a little about converting IRAs and Roth IRAs and things like that. Those, there is a 10% penalty if you take that out before age 59 and a half. If you take money out directly from an IRA, if you convert, this is a taxable event and would be, factored in for your liability for your taxes and towards your estimated payments. So this is, kind of just, kind of going over kind of the things we talked about before, but this also would impact your quarterly estimate. So things to, keep in mind that, if you do this and, let's say you didn't plan on it before, we need to look at that for your estimated payments and say, hey, if you're already safe harbored, that's fine. I tell clients, if you're safe harbored for the year, you've made your quarterly estimates and your withholdings are all fine and you've met your safe harbor evenly, you could owe $100 million on April 15th of the next year. There's no penalty because you've met your safe harbor figure. So, that's what we try to focus on, is make sure we have that safe harbor. So now let's see, I think we got a couple of more questions. If I request that Social Security withhold some taxes, will the taxes consider Medicare payments? So like I said, there's a cap on how much Social Security will withhold. So they won't let you withhold more than you would take home, less your Medicare payment. So that's not a concern on that way. I think that's why they came up with their 22% limit. So that way nobody is basically coming home with nothing on their Social Security. So I believe that's probably what the question was kind of going on. And again, is it mandatory to pay estimated payments? Again, no, not mandatory, but they will charge you interest because they are fine. Let's see. And then there was a royalty income question. So no, so the question was that do you have to submit estimated payments and pay into Social Security if my annual royalty income exceeds $400? So I'm not exactly sure what the question is going after. If your annual royalty income exceeds 400, that is taxable. And it, but if you want to give me a little more information on that, that'd be good. Now, if you're talking about royalty income related to self-employment tax, like royalty income in that way, that it's taxable to you as self-employment, at that point, if you have self-employment income that is more than 400, you do have to pay self-employment tax. So maybe that's where this question is going from. But if you want to kind of clarify that, I will go ahead and happily give you more information. And then will the IRS question unequal estimated tax payments if you base it on quarterly estimated income? So IRS, like I said, is going to assume you made your income evenly throughout the year. So if you are making uneven estimated payments so as to match up with your income, you just have to make sure that you or your tax preparer is using the annualization method that shows how much income you earn each quarter. So that way it will match up and we'll do the math based on that, as opposed to the default of assuming it was all even throughout the year. So the IRS won't initially, look at that. I have not had anyone have the IRS question any of our annualization calculations. It's not to say they don't, but I have not seen that. Okay, and I see we have the clarification on the royalty income. You were talking about self-employment. So yes, any self-employment income, be it royalty or not, if your net self-employment income is more than 400, you do have to pay self-employment tax. You do have to file a tax return, even if you are otherwise below the filing threshold. So 400 is the special sauce, as they say, for filing a return for self-employment income. And I guess one thing I didn't really mention that I think might be helpful to everyone, and if you're working with investment advisors and EBW, this is probably not a problem you've ever had. And if you're to the age where you need to take a required minimum distribution and you miss it, as I think you all know, or at least remember, in 2020, you didn't have to take required minimum distributions. It was a one-year deal. Starting in 2021, we're back on. Everybody has to take it. So I had a couple of clients who, stopped their distributions in 2020 and then 2021 forgot to turn them back on. So what happens? They missed a distribution. There is a penalty if you miss a required minimum distribution of 50% of that distribution amount. Now, don't worry, because there is the ability to request that penalty be abated. And I have never had that abatement not be granted. So if you do have this, now that's not to say that the IRS could change everything tomorrow and start assessing these penalties like they want and are valid, but historically they've been very generous. As soon as you realize you've missed a distribution for a year, you have to go ahead and fix that, take the distribution in the very next year as soon as you realize it's a problem. You also have to take the distribution for that year as well, so you'll have a double year. And then you can, when you file your return, you can request the abatement on form 5329, or you can file 5329 separately. And just, you have to say, I should have taken 10,000 out. I didn't take it. The penalty would be $5,000. And then you say, you basically ask for forgiveness and say, please abate the penalty. I inadvertently missed, taking the distribution. I've corrected the distribution. I've taken it, and just basically state your case. Like I said, historically, the IRS has been very generous in granting these abatements. But like I said, that's not to say it won't happen. So certainly don't bank on that. But, historically, they've been generous with that. And, hopefully that continues, because it is something that can just happen. But once just make sure you're staying on top of those RMDs and are taking them as needed. But there is an option for you if you do miss one, to kind of go down that road and see about correcting that. So let's see if there are any other questions. So if you convert your IRA to a Roth in December, will the IRS be able to realize this in regards to not paying taxes during the tax year? So the IRS will not know that you did that in December unless you told them. You have to tell them when you do the annualization for estimated payments. Again, you take out 100,000, they're going to assume you did it 25,000 each quarter, which isn't exactly right, because their quarters are wonky. If you didn't realize, quarterly payments are due April 15th, June 15th, September 15th, and January 15th. I think we all know that doesn't exactly equal out in a nice even quarter. So they don't know that you did that in December. You will have to tell them on the annualization, which is on form 2210, which is where your underpayment penalty for estimated payments is calculated. You have to tell them that, hey, 100,000 of my overall income happened in the fourth quarter. And then, if you're using a TurboTax or any of those out there, I use TurboTax as a generic term like Kleenex these days. If you're using TurboTax, your tax advisor, let them know, and they can put that in there and say that was all December. Now, if you already met your safe harbor, regardless of that money, then you don't have to annualize because you've already met the safe harbor. But if you didn't meet the safe harbor, then you have to go through that annualization form on the 2210 to let them know, hey, this is when I got it, therefore, my income wasn't earned evenly throughout the year. And then unless if there are no other questions, I think I've reached the end of my spiel, as they say.
Marnette,
Yes.
there's actually one more question that was put on the chat, and that's what
Okay.
happens if an IRA holder dies before taking the RMD for that year?
So it's a great question because the rules on that have changed recently, and it depends on what kind of beneficiary you are. If you're a spousal beneficiary, the rules are different than if you are, say, a child or just even unrelated beneficiary. If you're a spousal beneficiary, basically you can roll over the entire IRA into your own IRA. And if you're not to the point where you're taking RMDs, that's not a problem. So you can just roll that over, and then I don't believe there's a requirement for the RMD. If you are taking it into an inherited IRA, non-spousal, there are new rules for that. Used to be that you could basically take that IRA and you could, stretch it out, as they say, over your lifetime now, which means you could take it over, if you're 45, you'd be able to stretch it over another 40 plus years. So under the Secure Act, that went away, and you have to take the money out within 10 years. Doesn't have to be evenly, doesn't have to be, it can be in year 10 if you want. But you will have to start taking that money out. And if they have not taken the RMD, then there are special rules that you'll have to look at. When did the money come to you? When is it in your account? It could be that the estate has to include that in their 1041. So there's a lot of different moving parts with an inherited IRA, and I'd be happy to kind of go over it more specifically, with you if you have your, specifics, and we can talk about that. But this is an area that has just changed within the last 3 years. It is something that I think they're looking at to potentially make some more changes to, because they love to change these things. So you just have to be really careful with the inherited IRAs. Like I said, a spousal IRA is great because you can roll it over directly into your own. If it's non-spousal, there are very different rules involved.
Thank you, Marnette. We appreciate your time and certainly all the information that you've provided us with. For our clients, if you have additional questions, you can certainly email it to us. And I'm sure if we forward them over to Marnette, she would be happy to answer those questions. Hold on.
Absolutely. And my contact info is on there. Feel free to shoot me an email as well. Just if you don't hear from me in a couple of days, come back. My spam feature is very, very vicious some days. It doesn't let people through. So, don't hesitate to, circle back with me.
Yeah, just make sure you CC us or CC her, and that way, if there's some questions that were left unanswered, we can certainly address them. Again, from the Egenberger and Weiner advisors, we appreciate your time and hope this information was helpful to all of you.